What's going on, everybody? Fisher Trader again here. So for this day, if you hadn't watched the other two videos, this is video number 3 in a row. That's why the backdrop's all the same. So what we're looking at here, this is wrong. Sorry, a little OCD. Let's kill this all the way. There we go. Caught up. So, what we're going to talk about? Selling calls. But what is selling calls? Well, you're going to find out. So, I'm big on selling puts and collecting the premium, especially if it's a short term. The stock is solid. A lot of times, though, when you're selling a put, your credit that you receive is going to be much smaller than what you would receive in the event you bought a put and it went below that price. But you want a stock that's actually pretty solid. So like Ford is, even though it got beat down and the news is bad, $5 is pretty strong. GameStop, $3, strong area, but still above that. Selling calls. So what have I been doing? I have actually been buying the shares, okay? Here's the trick. Covered calls, okay? This is the big difference between just selling calls outright, because you still have to have either the collateral or the shares to purchase at that point. So we're going to buy the shares. Now, here's the thing. You want the companies that you buy, you want them to either not had any reverse splits, or at least not in a long time. You want them to be strong. You want them to have good volume, open interest on contracts. They have to trade options, otherwise you can't do this. So what we're going to do is look for companies we want, look at companies you can afford with your account, because if a share is $25 and you don't have, $2,500 in your account, you're not going to be able to get $25,000. You're not going to be able to get that in your, $2,500. If you don't have the equity or capital or shares already, you're not going to be able to sell the calls against it. So what works the best for me is buying the shares, okay? We look at the price that the shares are at now. We look at how much we paid for 100 shares, because each contract represents 100 shares. So you buy the shares, 100 lots, okay? That's how much it has to be. So if you get 500 shares, it's 5 contracts. If you get 250 shares, that's only 2 contracts, because you're missing 50 shares. You need to get in 100 lots in order to do this per contract. Equals 1 contract, all right? Here's the beauty of this. When you sell one of these calls against one of those lots of shares, you get a credit. Now here's the thing. You can sell week to week to week, and if it's guaranteed in your favor that you're going to sell these calls, collect this premium, and if the price is not going to go up, you're just going to continue to collect the credit, all right? Now, if you continue to do that week to week to week, if you can do it on stocks that have expirations like SPY, SPY is very expensive though, so if you have expirations like Monday, Wednesday, Friday, that's excellent, because you can do it back to back to back. If it's something that has monthly expirations, so like April, May, June, July, etc., or even gapped out in there, then you got to pay attention to that. But I will say that the credit increases, all right, over time, all right. So if we're looking at, because some of the ones I have now are for like January 2022. So if we go all the way to January 2022, but I paid, say one I got INNT, and this is not. Again, this is not trading advice. I'm not telling you to do what I'm doing or recommending what I'm doing. I'm just explaining what I did. So, January 2022, I got one. I think it's MFA, $185 for the shares. And what I did was sold the call against them. Hopefully my garage doesn't get open here. So, $185 for the shares. I sold the January 2022. 2022 calls for the premium that I received was $95, okay? So I literally just made about a 50% return by selling those calls immediately against the shares. Now what's gonna happen? My cost average, already $185, that's $1.85 per share, okay? So I just got $95 credit back for this. So if I sell the $2 call, which is very high probability to happen, I'm still keeping the credit, and I'm actually selling at 15 cents per share times 100, or however many contracts I had. to actually make that money continue to grow. I did read about selling deep in the money calls, okay? And those deep in the money calls would actually net you a higher credit overall. But if it gets exercised, you're not going to, you're going to keep the credit anyway. But if it gets exercised because the price goes close to expiration, then you'll have to sell those shares. You're committed at that lower strike price. But you did get a higher credit in the first place. Here's the trick. If you got a $150 credit, okay, for selling those shares, way out there on selling the calls, and you got a $150 credit, but now the time is getting closer, you're not going to wait till expiration. No expiration. Say this got down, say the credit is now at $80, all right? That difference there, you can buy back the contract you sold. You got $150 for it, you can buy it back at 80 bucks and close the position. And now you just made your money just like that. And that is the basis of buying shares and selling calls, aka writing or selling covered calls. And that'll be all for this short, quick video on that. I do thank you all for watching. Dennis the Fisher Trader. Check out the YouTube channel. I got plenty of videos. These videos will go up on there. I'm getting better with my videos, so hopefully, the editing wise will get better over time. Maybe I'll get somebody that can do it for, more professionally than me. But again, thanks for watching.